With over $2 trillion in market value and an estimated 200 million users around the world, the digital asset sector is coming under increasing scrutiny by regulators. But the challenge is how to set new rules for something that is decentralized by design.
Technology in itself is not good or bad, right? The important thing is to have regulation that pretty much legalizes the framework and kind of eliminates the bad actors and does not allow them to operate, which is what you see the likes of Singapore doing and many other countries.
According to digital currency exchanges like Luno, banning crypto outright would mean shutting the door on the underlying blockchain technology and its benefits. It could also push investors to look for alternative options.
More people will just find ways to still put their money into cryptocurrency. Oh, so if this exchange cannot, okay, then maybe I'll find another exchange. Maybe I'll go through VPNs. Instead of fostering growth, facilitating growth, you are only pushing people to go towards maybe just circumvention of the rules.
But there are challenges in formulating guidelines for an industry that's still evolving.
This flexible approach, right, it allows for both industry players and, for example, in Singapore, MAS to grow and learn and to facilitate growth of these exciting industry. Rather, if we take a look at the the United States hardline stance against cryptocurrency, where they view it as a form of security and the application of their existing securities laws on it, what this essentially means is that the retail investors have to report their realized gains and losses, and the failure to do so will invite scrutiny from their authorities, right? So this rigid and blanket treatment of cryptocurrencies will not only, it will just deter financial development and innovation in such novel areas of technology.
Countries will also have to toe a fine line between regulation and innovation.
This is precisely why Singapore is such an attractive jurisdiction, because apart from being a good regulator, where they, rap on the knuckles of your non-compliant entities, they also recognize that too much control over the players will also stifle innovation.
The Monetary Authority of Singapore is among regulators that have taken action against crypto exchange Binance. It's ordered Binance to stop providing payment services in Singapore. The global site, Binance.com, is on the MAS Investor Alert list. Binance is facing a regulatory backlash globally over consumer protection issues and its compliance with anti-money laundering rules.
It shows you that regulators are taking an active stance here. This crackdown on exchanges that are not meeting requirements. These are positive indications of the asset class and the industry maturing, right?
The local site Binance.sg remains open to Singapore investors. It's been granted an exemption from holding a license under the Payment Services Act, while its license application is being reviewed. To date, 3 players have received licenses to offer digital payment token services under the Act. They include a unit of DBS Vickers, Australian cryptocurrency exchange Independent Reserve, and fintech firm FOMOPay. DBS Vickers is a member of the DBS Digital Exchange, or DDEX. It's the only player backed by a traditional financial institution.
Traditional banking institutions, as you know, have payment system, custody, capital market expertise, and importantly, established checks and processes, particularly in the area of AML, KYC, anti-fraud, and security. In the long run, this could help improve the robustness, transparency, and credibility of digital asset ecosystem and encourage greater market participation. From DBS perspective, our aim was to create a transparent, secure, and reliable platform that serves the entire digital asset value chain, from deal origination to tokenization, listing, trading, and custody. And all this is done within a trusted and regulated franchise.
But Singapore's regulations are geared primarily towards protection against money laundering and terrorism financing. Digital payment tokens aren't subject to consumer protection measures.
Those are really key standards with regard to money laundering, fraud, onboarding and KYC checks for consumers. That is basically 90% or 95% of the job, right? Which is if the regulator is able to make sure that the exchanges that operate are licensed according to a set of standards, that takes care of pretty much any kind of major issue you would think of, right? There's obviously this 5% chance that there's a token that might come out of the blue that might not be kind of something that consumers might trust.
Market changes can affect players, no matter what their size. But according to market watchers, the impact on users and the broader crypto space is expected to be minimal.
There will always be new players to take up positions of those that have fallen. The industry will always develop and evolve. New exchanges will pop up. Those who cannot use Binance anymore will just find another way to trade crypto.